Today, Robinhood's board approves a plan to buy back Sam Bankman-Fried's stake. JP Morgan lays out what could happen to Ethereum's staking ratio following the network's next big upgrade. And we take a deep dive into the shift of investor sentiment away from centralized exchanges following the FTX collapse. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Crypto prices in the red today. Bitcoin dipped 1.5%, trading around $22,500. Ether dropped more than 1%, but still traded above the $1,600 mark, and the Matic token fell nearly 2%. Okay, let's talk about the top stories. Robinhood's board approved a plan to buy back Sam Bankman-Fried's $578 million stake in the company. You might remember the FTX founder purchased his stake in May through Emergent Fidelity Technologies. Robinhood's chief financial officer told CNBC that the company is working with the Department of Justice on the plan. In its earnings report, Robinhood said that there's no guarantee when or if the share purchase will happen. The DOJ confiscated those 55 million shares last month, and those shares are at the heart of a dispute between SBF and international, as well as domestic entities, including crypto lender BlockFi, which filed for bankruptcy in November. Meantime, Sam Bankman-Fried was back in federal court in New York today after prosecutors raised witness tampering concerns. SBF's bail conditions have been tightened in response to those allegations, and today, a judge extended a ban imposed last week on the FTX founder's ability to contact employees of companies he used to run. SBF is also still not allowed to use encrypted messaging technology while out on bail. Today's hearing was scheduled after prosecutors said he sent an encrypted message on Signal last month to the general counsel of FTX, asking to reconnect to see if there's a way to have a constructive relationship and, quote, vet things with each other. Next, Ethereum's next major upgrade, the Shanghai hard fork, which is expected to take place next month, will raise the blockchain's staking ratio in the medium term. That's according to this JP Morgan research report released yesterday. The bank noted that compared to other major proof-of-stake networks like Avalanche and Solana, Ethereum has a relatively low staking ratio of about 14%, while the other networks on average account for 60%. That indicates there's plenty of room for the Ethereum staking ratio to increase after the upgrade. The analysts also argued that a significant portion of the future increase in staking will likely move to liquid staking protocols like Lido, which let Ether holders stake without running a validator node and enable liquidity for staked assets, which would otherwise be locked in the staking contracts. Finally, Coinbase CEO Brian Armstrong warned yesterday that he's heard rumors the SEC wants to, quote, get rid of crypto staking by retail investors. He tweeted yesterday that if that were to happen, it would be a, quote, terrible path for the U.S., arguing that staking is a really important innovation. We reached out to the SEC for comment, but did not immediately hear back. Bloomberg reported that SEC Chair Gary Gensler previously indicated that staking could fall under the agency's scope, while Armstrong argues staking is not a security. Over the summer, Coinbase reportedly disclosed that the company is being investigated by the SEC over its staking programs. All right, on to our main story. The SEC's potential ban on staking could further drive users away from centralized exchanges and onto decentralized exchanges. Consumer sentiment regarding CeFi has already shifted following FTX's bankruptcy in November. Crypto World's Mai Tejapai takes a deep dive into what sets DeFi and CeFi apart and why people turn to decentralized exchanges following the high-profile bankruptcies and scandals of 2022.
Centralized exchanges once had a reputation for being the easiest and safest way to trade crypto. Compare that to decentralized exchanges, which are seen as more transparent, but also considered unregulated, hard to use, and plagued with scams. Those sentiments changed after the FTX collapse.
Obviously, we're leaning more on the decentralized side of preferences right now for very understandable reasons. Right now, the trust is broken, understandably broken.
In November, Forbes reported that decentralized exchanges, or DEXs for short, gained more than a 79% increase in trading volume from the previous month. As the FTX scandal was unfolding, ETH spot trading volume surged by 700% on the decentralized exchange Uniswap. That's according to Coinmetrics data. Now, a couple of months later, Coinmetrics found that ETH spot trading volume on both centralized and decentralized exchanges is trending down on Uniswap and Coinbase. But that hasn't stopped some from seeing decentralized exchanges as the safer way to trade crypto going forward. What sets decentralized and centralized exchanges apart? And how has the FTX scandal changed users' perception about the technology? A centralized exchange is run by a single entity, often a company like FTX, Coinbase, and Binance. It is permissioned, meaning users go through a verification process known as KYC or Know Your Customer. KYC makes the sign-up process easy and gives users a sense of security.
Folks are comfortable interacting with centralized exchanges. We've been doing it forever, and so they're far more comfortable if they have their AML KYC frameworks for you to be a client.
Centralization allows for easier access for people who don't want to go through the process of setting up their own wallets. They just want exposure to crypto. And it provides a plug-and-play avenue into a more traditional portfolio too.
But having a middleman also means information is centralized and less transparent, and companies take custody of customers' funds. In other words, they hold the private keys to users' crypto. On the other hand, a decentralized exchange is permissionless, unregulated, doesn't require KYC, and allows for self-custody. Users have full control of their funds, but that also means more responsibility and a higher degree of user sophistication.
When it's a decentralized, permissionless blockchain, anyone, with the right technical knowledge can go and deploy whatever they want on it. It's part of the way the network operates. It's permissionless, so you don't have to go through various checks, etc. It's completely open. That is a challenge. One could expect that in financial ecosystems that are completely open, there would be a concern around people, doing whatever they want, basically.
Decentralized exchanges are transparent, though. Anyone can take a look at any transaction on the blockchain. And in the wake of FTX, where billions in users' funds were left unaccounted for, the transparency of a decentralized exchange has become more appealing.
Throughout the day as trading activities going on, you don't actually understand how much that centralized exchange has in any given asset that could be in cold storage somewhere, or is it all in online and in hot storage to be able to measure it. From an accounting and transparency perspective, the decentralized exchanges are going to be very helpful and very interesting. Everything is transparent on chain. So you can understand the movement between addresses. You can understand the reserves that a decentralized exchange has.
Some even say it could help prevent the misuse of customer funds, like at FTX.
I think DeFi is in many ways the solution to a lot of the problems that we saw throughout 2022, as long as it's actual DeFi and fully on-chain and observable. We give people the opportunity to monitor those things, and so you don't have to trust an Alex Mashinsky. You don't have to trust the Sam Bankman-Fried. You can really analyze for yourself and audit these firms to know without any kind of trust assumptions what the state of your finances could be.
In DeFi, yes, that would have made that technically extraordinarily challenging, if not impossible, to do.
But transparency alone cannot solve all mismanagement and fraud.
It's important to note that transparency doesn't necessarily lead to accountability. You have to have frameworks if things go wrong. I think the concern is human behavior, right? So the problem with FTX wasn't necessarily a technical problem. Humans have been exploiting other humans since the dawn of time, and we shouldn't expect that that's going to stop. So how do we create technical systems and a set of rules and policies that are going to make that, disincentivize that kind of behavior, make it harder to do, and create accountability and consequences for if people decide to go down that path.
Still, DeFi exchanges aren't mainstream yet and have a long way to go.
The biggest problem that is going to come up is how are the regulators going to handle decentralized exchanges? And I hope they figure out a framework that allows them to flourish and continue to do the work they're doing, because I think they're an excellent solution for understanding proof of reserves and what does the exchange actually have and how is movement behaving.
Right now, the learning curve on using DeFi it remains a little challenging, but there's things that are already happening to make this more user-friendly. And as that happens, I think we're going to see more and more movement into DeFi because it's tremendously exciting. The opportunity to really control what you do with your funds is very amazing, right? And the opportunity to recognize that you aren't beholden to the biases of any system that isn't working for you and for your family is really exciting.
Okay, that's all for Crypto World today, but we'll be back again tomorrow. We'll see you then.